You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
This is a very unusual period where gold this year, gold this year is up about 25% and the gold stocks are up about 26%. It's a very, very unusual circumstance at the beginning of a gold bull market. So unless I'm wrong on it being a beginning of a new gold bull market, I think the gold stocks are incredibly undervalued right now.
Welcome to Mining Stock Education. My name is Brian Letty. Today with me, I have Adrian Day of Adrian Day Asset Management. In our conversation today, we will be discussing Adrian's views on M&A in the sector and the copper and gold markets. Adrian, it's great to have you. And let's start with the big news of the week. Lundin Mining and BHP are forming a 50-50 joint venture to acquire Filo Mining. It's a huge deal, a big money deal. Do you think this deal opens the floodgates for investment in Argentina?
Oh, gosh, that's a good question. Good morning, Brian, and thank you for having me. We could say it's an endorsement of Argentina by two of the major players. So yes, I don't know about it opens the floodgates, but certainly, I think certainly it would give people a little more confidence to go into Argentina. And we've been seeing that, of course, over the last year or 6 months. But yeah, and of course, it's also very much a province by province issue in Argentina. You can have a provincial government that, bans open pit mining, for example. So we shouldn't forget that. Where this mine is, the Filo is in a traditional mining area. So it's, from that point of view, perhaps less of a revolutionary move.
Do you think the key factor is Milei? Do you think that a deal like this maybe happens regardless of Milei being in power, or is he the key component?
Oh, no, I think he's critical. It gives people confidence because, apart from under the last government, you had all sorts of problems, right? I mean, you had problems with permitting, getting a permit, but you had problems with the currency declining, which if you're a foreign investor in the country is not so bad. Your local costs are going down. But if you're not allowed to take your profits out of the country, then that's a big problem. And of course, one of the things Milei has done is opened up the exchange controls. So that's very important, very, very important.
The whole aspect of this deal being 50-50, and I realized Lundin had, I think it's 30-something%. And so they sort of had a controlling interest in, from a market cap perspective, bringing in BHP as a partner makes a lot of sense. But my question is, 50-50 deals, do you think this is more of what we'll see in the future, given the huge CapEx? And
yeah, so I don't think 50-50 deals are going to be typical going forward, but the exceptions would be huge deals like this one. And also, as you say, very importantly, Lundin already was in control. So if Lundin had just been looking at this from the outside and said, we'd like to buy it because of our nearby mines, say BHP, do you want to join with us? Maybe it would not have been 50-50. Maybe BHP would have wanted control. So I think this is perhaps a little bit exceptional. But BHP has shown before it can work in 50-50 deals. So there's no reason we won't see it in large deals, really large deals.
On the smaller scale, we saw Agnico Eagle take a roughly 10% position in Foran Mining. And I thought it was quite interesting because it's definitely a focus or a step towards copper, but in a totally different genre in terms of not the porphyry, but to go after high-grade VMS deposit in Canada. I guess the question is if you have any thoughts on this deals and whether that is more likely for some of the other senior companies to take a step into copper.
Good question. Agnico has traditionally been much more active in taking small equity positions in small companies. It's been much more active in that area than many other of the large companies. And they don't always come to fruition. I mean, meaning Agnico doesn't always wind up buying a deposit. But they've been much more willing to take positions in small companies and sometimes just plain old exploration companies. So I don't think this denotes a change for the sector, frankly, because it's something Agnico's been doing. But Agnico has said that, we know Agnico is interested in copper. They've said they are. They have the copper in Mexico. But I think more and more of the larger gold mining companies, as you know, are turning towards copper. Newmont, of course, bought Newcrest. I mean, I think it was more for the copper than for the gold. Barrick now calls itself the Gold and Copper Company. So that's a complete rebranding. So I think we're going to see more interest in copper for copper's own fundamentals, and also, frankly, because it's increasingly difficult to get a company to grow meaningfully if you stick to gold, other than M&A. So I think you're going to see more interest in copper, and of course, this is a big thing about the BHP Lundin deal on Filo. People look at it and say, "Wow, that's a lot of money," but it is a lot cheaper to buy something than it is to explore and discover it. And then if you're looking at a more advanced project, and particularly if you're looking at a mine that's already in operation, not only is it less expensive to buy, but it's also less timely. I mean, more timely. I mean, in other words, you can buy something that's got a permit, that's got community relations, depending on whether we're talking about development or mining. If it's already in mining, it's already producing. You go out and discover something, it can be in the copper business, it can be 15 to 20 years before you actually start producing anything. So it's cheaper and it brings the timeline forward.
You mentioned growth and how the copper, obviously is a tremendous growth aspect to why these companies want to get into the copper space. Is there any other metal that sort of fits that, or is copper the one because it has the porphyries, copper gold porphyries, and you can kind of kill two birds with one stone?
Well, you mean for the gold companies?
Yeah, no, for the gold companies.
I think copper is definitely far and away the one that they're most looking at. There are some companies that don't mind having, a little bit of something else, but I don't think you're going to see a major mining company in the near term. You're not going to see a major mining company go out and buy a zinc mine or a lead mine or that. I don't think that's going to happen.
Okay. I was in Newfoundland recently, and I had a chance to sit down and talk with Brian Dalton of Altius Minerals. And he described the current copper market M&A scene as mating season. And
sorry?
He described the current copper M&A situation as he said it's akin to mating season, or the rut for deer hunters, or that sort of thing. I thought that was quite funny. But I wondered, where do you see the most likely? We saw the big deal with Filo. What do you see next in terms of M&A? Is it going to stay near the top with the majors, looking to consolidate, or is this something on the grassroots level?
Well, of course, in the case of BHP and Lundin, they're not looking to consolidate. They're looking to share the huge cost of a potentially very large deposit. I think we're probably going to see more of projects along that near Filo, along that part of Argentina. We're going to see more of them gobbled up, I think. Probably Lundin and BHP will be the buyers, and they don't need to be in any hurry. But there's several companies in various stages of exploration along that trend. So I think we'll see more of that. No, I'm not thinking. I mean, you never know in this business, of course. And there's lots of reasons why a company can decide to go after another big company, or why a big company can decide that it's time to sell. There are lots of reasons. I think we're going to, more likely in the near term, we'll see, the second tier companies, maybe like Capstone, for example. That's just an example. They might attract attention because that's a company, and there's other companies like that. Companies with, more than one mine plus a reasonably attractive pipeline of projects. So that might be attractive to a major company who wants to expand into copper. Something like that. I'm not saying, please, I have no particular insight on whether Capstone is being looked at right now, but that kind of company, that kind of intermediate copper company, will get some attention. And, you've got companies like Teck and Lundin that are just below the top tier. I wouldn't be surprised if we saw some amalgamation among, that second tier company.
Further in my conversation with Brian, the topic of jurisdictional risk came up. And I had coined a phrase to him that had basically talked about Canada and the States, or parts of the States at least, and parts of Canada being less risky. And he reminded me of their Argentia coal mine in Alberta. And I don't know, it was like $200 million debacle that the Albertan government and the federal government of Canada kind of impacted, their future royalty revenues. And he's absolutely right. Jurisdictional risk is ubiquitous. Last month, Zijin tried to do a $100 million investment into Solaris. And as most of us know now, the Canadian government blocked that deal. And I thought of all the ways, Adrian, of how I was going to lose money potentially in that deal. I didn't think it was going to be because of the Canadian government.
Well, yeah, no, you're absolutely right. Now, Brian, of course, is still a little bit raw on that Genesee royalty. And, he has a right to be. This was a clear takings by the government. And, in the US and Canada and some other, first world jurisdictions, takings by the government is supposed to be compensated. And in this case, as you know, they compensated the coal mine owner, but not the royalty owner. And I haven't read the opinion, and I'm not a lawyer, still less a Canadian lawyer. So, I'm not quite sure what their reasoning was, but I think that's very, very damaging anyway. But yeah, Canada has been particularly aggressive. As you know, this isn't the first time that Canada has said to a Canadian incorporated company, we don't want the Chinese buying your mine in a third country. And, it raises a question as to, what right does Canada have determining what goes on between a Chinese company and Argentina, a mine in Argentina, for example, that's already been approved by the Argentine government, the transaction. They're behaving a little bit like America, telling the whole world how to behave.
So, but do you think we've seen the fall? Because I look at this, and when you eliminate the Chinese, or I guess you could it's probably not just the Chinese. You could say anybody maybe associated with Chinese outflows. But when you eliminate them from M&A, especially for these large copper deals, doesn't that really narrow down the market for who's going to buy these things and the competition? And have we seen the repercussions of what happened with Solaris in the market yet?
No, we haven't seen it in the market, but you're absolutely right. And, you can look at BHP and Rio Tinto and Barrick, for example, which I assume all three the Canadian government still likes. But even if those companies are actively interested, there's only so many big copper projects they can afford to buy at any given moment. So it does restrict the M&A potential enormously. And then, as you indicated, you have to ask who's next. We know that the West has a bee in its bonnet about China. People in the U.S. Congress standing up and calling it the enemy. I think that's very dangerous talk. But anyway, that's a different subject. We won't go there. But So it's been a long-standing and fairly deep hostility in North America and in parts of Europe towards China. But I mean, who's next? If Saudi Arabia wants to buy an oil project, is Canada going to say no to them? I mean, where do you stop with this?
Well, you know what's interesting, because that 100 million has resurfaced. The Zijin went and invested in Montage Gold, and I think it's basically the same amount of money. I guess the question I have for you that's kind of contrary is, copper is considered a critical mineral or critical metal, yet gold, by my view, should be along the exact same ranking, but it's not. They take the gold, So what do you think of that?
Well, yeah, from a monetary point of view, it is critical, of course, because it's money. But yeah, I don't think governments are going to consider gold as a critical mineral anytime soon. They should, but they're not. So, yeah, but I mean, you're right. I mean, if we and we're fortunate that the money went into Montage. I mean, it could have gone somewhere else. And Canada and Canadian companies and Canadian investors got no benefit at all out of it. And we've seen that before when a Chinese company is rejected for a project, they go and buy something else. It might be in Indonesia, and the US gets no benefit, or the North Americans get no benefit.
When it comes to jurisdictional risk, it's definitely important to try to understand what you're dealing with that particular country's culture and such. My question is, what does it mean to you to understand a jurisdiction? What kind of criteria do you put on yourself to say, oh, hey, you know what, I do understand what's going on there?
Okay, that's an excellent question, and it's a different question than most people ask on jurisdictional risk. So let me answer that in 1 second. I think, first of all, you have to look at what do you buy. If you're looking at a copper project that's in a development stage, you may well be looking at 5 years minimum before they produce anything, and you may well be looking at 30 or 40 years or more that they're producing. So your view of political risk in a country is going to be a lot different from that of the company that's looking at a gold mine, maybe 100,000 ounce producer for 10 years. Your view will be a little bit different. Because I remember Jorge Gonzaga from Fortuna, when he was asked about the problems they were having in Mexico and so on. And he said, all these things come and go. Mexico used to be the flavor of the month. Now people don't like it. And next is Argentina. And he said, you just got to kind of look through that if you're looking at exploring and building and developing a project, because you're going to go past at least one jurisdiction, one administration, and probably two administrations. So people looking in Mexico are looking ahead. In the case of a copper mine that's going to be around for decades, well, you can look at what Milei's doing now, but the truth is, when your capex is being spent and the mine is coming into production, Milei's administration will be long gone. So I think the most important things to look at, if you're looking at, so it's a big difference whether you're looking at a long-term project or a shorter-term project. But if you're looking at a long-term project, you've really got to look at just the culture of the country and the people. Is there a mining culture? Is there a mining history? And you're still taking a bit of a gamble, a bit of a risk, but certainly in parts of Argentina and certainly in Peru and Chile and Mexico, there is a mining culture, and there are people, there are mines, there's a history of mining, and there's people, educated in the business. So I think those things, if you're taking a longer term view, are more important than what is happening now. But I mean, clearly also, if you're thinking of building a mine or buying a mine that's already producing, you want to be able to get your money out. So you're not going to put money into a country where there's exchange controls and you can't get your money in.
Right. As an investor, should you ever expect I'm going to say a culture, but should you expect culture to ever change? Like if somebody has a propensity to 8 out of 10 times they vote their left-wing governments, and the blip is, or the anomaly is, something more conservative or business oriented, is it wrong to think that would ever change in the future?
No, not at all. Of course not. Cultures do change, but a culture will change, much more slowly than particular laws or particular economic edicts and so on. But yeah, the culture can change. It can change over time. And sure, I mean, you can look at countries that have progressed economically with a vibrant middle class. And, as people get wealthier, they're certainly less interested in, quote, dirty jobs. And that would include, at the moment, despite, some efforts that are being made, by Robert Friedland in South Africa, and Agnico and Barrick are both leaders. But it's still a dirty and relatively dangerous enterprise. So as people become wealthier, they're less interested in that.
Let's move on to the gold market. A rising gold price is great for a gold investor. The equities eventually catch up, I hope. But what I wondered for you is, when you see a rising gold price, do you see that with mixed emotion? Because obviously it's usually the gold price rising is something that risk is increasing.
Yeah, I know Rickroll loves to say, that he's got, a bunch of gold, and the last thing he wants to see is gold at $10,000 an ounce. We know why gold is rising at the moment. So I'll answer the question, but from a different point of view, if I may. We know why gold is going up at the moment. Gold is going up, number one, because of the central bank buying, led by China, not the last 2 months, but led by China. But many, many central banks are buying gold, and they're buying it to diversify their reserves, and specifically to try to isolate their reserves from the weaponization of the dollar. So, the weaponization of the dollar, in my view, is not a good thing, but it's not like a global catastrophe in the sense that you're asking your question, I don't think. That's been the primary driver of gold over the last 18 months. Maybe a third of all gold buying has come from central banks. You've got Chinese buying, Chinese investors, not central banks now, but Chinese investors, the Chinese consumers are buying gold because they're concerned about the fragility of their own banking system. And, they don't have a lot of other places where they want to or can put their money as a security, as a safety. You don't buy real estate if you're Chinese right now. The stock market has gone down for the last 18 months. Doesn't look like a safe place to put your money. They're not allowed to buy crypto. So gold is a safe place. So both of those factors, those are the two major drivers of gold over the last 18 months and including into this year. And they're not reflections of catastrophe on the global scale. So I think what's going to happen in the near term is we're going to get in the West, led by the US, but also in Canada and in Europe, we're going to see interest rates come down. We've seen it in Canada a couple of times, of course. We've seen it in Europe. And we're just waiting for the Federal Reserve to cut rates. And typically, when the Fed cuts rates, gold always moves up from there. We'll see a slowing economy, and a slowing economy is actually positive for gold, not because of a direct correlation between a slowing economy and gold, but because when the economy slows, investors look ahead and say, that means more easing on the part of the Federal Reserve, which is positive for gold. So the things I'm talking about, a slowing economy is not a particularly positive environment, but I think again, it's not a global catastrophe if we have slowing economy and cutting interest rates, and that's what's going to spur gold.
So let's go with that theme of, weaker economy leads to quantitative easing, lower interest rates. And this is just, I'll speak personally. If you asked me back 10, 15 years ago, I would have said, oh, you know what? After 2008, there's no way we can keep on this trend. I was completely wrong. They've kicked the can so far down. It leads me to believe at this stage that maybe we can just keep on repeating this cycle of increasing debt and, expansion. And I don't even know if it does necessarily contract. So my question is, do you foresee a reckoning where we as a society, as a global society, can't continue this sort of cycle that we're on?
No, absolutely. That's a good question, but absolutely. There's no saying, I wish I could remember who said it, but there's no saying there's an awful lot of ruin in a country, meaning that, it can take a long time for a country on the wrong path with the wrong economic policies. It can take a long time for that to lead to, economic ruin. And the larger the country, the wealthier the country, the longer it takes. And particularly if you were, in the case of the US, if you were the world's reserve currency, where basically you could print as much money as you wanted, knowing that other people around the world would have to buy it. But any wealthy country can build up, a wealth of infrastructure, a wealth of savings. And so wrong economic policies just take a long, long time to lead to economic ruin. But we're getting to the point in the US, I think, if you look at the lower 50%, and I'm focusing on the US because obviously it's the largest economy, but it's also where I am. The lower 50% of the population in terms of income and in terms of assets are really beginning to struggle on a truly fundamental basis. The majority of people in the US could not put their hands on $3,000 for an emergency. I would say probably 30 to 40% of people in the US are living paycheck to paycheck. So when the paycheck comes in, they have to decide, what do we spend it on? The paycheck's gone, there's nothing left. I think we're getting to the point where that's really going to spill over into some very, very hard economic times for people. You've seen over the last 18 months, consumer spending has continued to go up in the US, and that's an aggregate, of course. So there's wealthy spending, there's poor people spending. But interestingly, consumer spending has gone up at a lower rate than inflation. So what that means is people are not continuing to buy the same amount of goods and services that they were. They're already cutting back because of inflation. But more significantly is that you've seen the savings rate after the COVID lockdowns, when savings went up, you've seen the savings rate come back to pre-COVID levels, in fact, come back to like 10-year lows. And you've seen credit card debt explode upwards in the US. So what this means when you think about it from a personal point of view, it means the person that was buying stuff for his family 2 years ago is continuing to buy most of those things for his family, but is not out of income, but out of debt. And that simply cannot go on forever, especially when the credit card companies are charging people, as much as 30 and 32% interest on their credit card balances. That simply cannot go on much longer. Now, yes, the government can just, print more money and, just distribute more money to people. But that leads to problems at the extreme. That leads to problems, in trying to sell your debt. I mean, already for various reasons, we're seeing the groups that were the major buyers of US debt are either no longer buying or are actually selling. So Russia obviously is out for, unique reasons. But China is also selling down their US debt reasonably aggressively. I mean, we could say 10 years ago, but they were continuing to buy, but at a lower rate than the pace than they were in the past. But now they're actually net sellers. Japan, I think, is going to turn a net seller soon as their interest rates move up and their currency improves a bit. You're going to see Japanese institutions bring the money back from overseas, whether it's US or Europe or wherever, and invest in their own debt. U.S. regional banks are not buying so much. Are not buying so much for treasuries for again, special reasons. The mark to market was what hold to maturity was what caused the problem with the Silicon Valley and the other regional banks in the U.S. a year ago. The Federal Reserve, of course, at the moment is not buying, but notably they reduced the rate at which they cut the rate at which they were reducing their holdings of treasuries significantly last 2 months ago. They cut it down. I don't have the numbers in front of me, I'm sorry. But it was cut by more than 50%, the rate at which they were reducing the balance sheet. But nonetheless, they're not a buyer of treasuries at the moment, and they're the largest holder of treasuries that there is. So one by one, different groups that have been large buyers of treasuries are failing to buy. And that means you're left with people that are more market-oriented, such as, hedge funds. Look at Cayman and Belgium are two large buyers of treasuries. Well, it's not the Belgian National Bank, I can tell you, nor is it the mythical Belgian dentist that's buying. It's hedge funds in Europe that are buying through Belgium. And in the case of Cayman, it's North American hedge funds that are buying through Cayman. Well, those groups demand they will start demanding higher interest rates on treasuries. So it has an impact. It has an impact sooner or later. If the debt service component of already it's the largest single budget item in the US, it's just servicing the debt, and it's going to get worse anyway, as T-notes from 5 years ago roll over. They roll over, 4, 5, 6 years ago, they were paying, 2.5? Now they're paying 5. So it's going to get worse anyway, unless the Fed cuts rates dramatically very soon. But, when you start paying 35, 40 and more % of your budget is simply on servicing your debt, well, it does mean that there's less money available for other things that the government does, good or bad. But it does mean that there's less available for other things. And that means that your infrastructure starts to fall apart. It means your military isn't as ready as it should be. It means that welfare recipients get upset, if their benefits are cut, etc. So, it's where we're heading. Reckoning is a good word. We're heading to a reckoning, I think. But if I may, can I just come back to something you referred to earlier, which when you said gold has gone up and hopefully the gold stocks will catch up sooner or later. First of all, we know the reason, if you think about it, the reason why the gold stocks have lagged gold is actually quite logical. When you think about who's buying gold and why are they buying it? Central banks are buying gold as a protection against the weaponization of the dollar. So central banks don't buy gold stocks anyway, but if that's your motive, the last thing you want to do is buy US gold stocks, right? And so if you think about the big groups that are buying gold, it makes absolute sense why they're buying physical gold and not gold stocks. If you look at gold stock buyers, let's say in the West, in North America and Europe, why are they not pouring money into gold stocks right now? It's because the macroeconomic environment is actually negative for gold. High interest rates, low inflation, and inflation declining, a strong dollar, a strong economy, apparently, and a strong stock market. I mean, that's exactly the environment where you don't want to buy gold stocks. So it's not illogical that gold stocks are lagging gold when you look at who's buying and why are they buying. But I would say to people that you really have a very, very unusual opportunity right now to buy gold stocks when the gold stocks are very, very cheap, when the gold price is high, meaning the cash flows are going to be very, very strong, when the outlook for gold, in my view, is very, very positive. But in addition to that, you're at the cusp of a bull market in gold assets, and yet the gold stocks have not moved more. I didn't say that very well, but normally, typically, at the beginning of a gold bull market, the gold stocks will have tremendous leverage at the beginning of a bull market over gold. So you go back to 2001, for example, in the first 3 months from when gold bottomed, gold was up 12%. The gold stocks were up more than 50%. And that's a typical pattern. 1976, it was true. 2008 is another example. 2008-9 is another example where the gold stocks were up 100% in 3 months off the bottom. This is a very unusual period where gold this year, let me just look, gold this year is up about 25% and the gold stocks are up about 26%. It's a very, very unusual circumstance at the beginning of a gold bull market. So unless I'm wrong on it being a beginning of a new gold bull market, I think the gold stocks are incredibly undervalued right now.
Right. The most money I've made as an investor in the sector is in 2016 and 2020. And those were gold bull markets. The interesting thing, and I guess it probably depends on your scope of duration and how you look at an actual cycle, but I would say that comparatively, the 6 to 8 months where I made money seems quite small. And so what I was going to say is, what do you foresee in the future? Is this a gold bull market that's 10 years in length, 3 years, 6 months? Like, what do you think?
Well, it's interesting. I was going to say, you think 2016 and 2020 were great bull markets. That's because you're so young. Yeah, I mean, obviously 2020 and 2016 were kind of special situations. And as we know, they were not really the beginning of long-term bull markets. Although having said that, gold bottomed in December of 2015. So, you could look at it as a kind of very, very sluggish and uneven bull market that's been going on for 9 years now. I think those two were special, particularly 2020 because of COVID. The moves were exceptional, but also the reasons for them were somewhat different. Gold bull markets typically last many, many years, and it all depends on how you count a bull market and how you count the inevitable pullback that occurs in the middle. But you look at 1970 to 1980, that was 10 years. You look at 2000 to 2011, that was 11 years. So, and you go back in history, and gold bull markets tend to be long, albeit frequently interrupted by significant pullbacks. So in the 70s, it was 74 to 76. But you look at that period from 76 to 1980, that's 4 years, the gold stocks actually went up by 800%. You look at 2001 to 2008, which is when we had the great financial crisis, which interrupted that bull market. But 2001 to 2008, they quintupled. 2009 to 2011, that's only, well, beginning of 2009. So that's basically 3 years to 2011. They quadrupled. So gold stocks can have phenomenal moves in reasonably short periods of time. And yeah, I think we're going to see a multi-year bull market. It's underway right now, but this is going to be a multi-year bull market as interest rates come back. And typically when the Fed first cuts rates, gold has a big move. As the dollar falls against other currencies, as the economy slows, with people thinking there's going to be more QE, I think we're going to see a multi-year bull market, at least 3-4 years.
What about the role of social media and the fact that information is so readily available if you want to access it and put the time in? Do you think that has any effect on duration or value recognition in the future, where it could potentially play with that cycle and change it?
Yeah, well, it certainly has a difference in value recognition. Although how much social media and Reddit and all that crowd looks at value, I'm not quite sure. They're looking at something different from value, but certainly value is more difficult to find absolutely outstanding and unrecognized value these days than it used to be. I'll just tell you a story. When I first started managing money, I remember in 1990, right? We've always invested globally. So a thing called Morgan Stanley Capital International, I don't know if you've heard of them, they're the recognized authority for global market indices. So the benchmark most people use will be the MSCI, Morgan Stanley Capital International Global Index, if you're a global manager. And in 1991, there used to be a book this thick that was sent by mail once a month. That's where managers got their information on global stocks. So I would get that book and I would comb through it, looking at things markets I was interested in. You know, I'd go to and look for valuations. And that's where I found Telefones de Mexico. Telefones de Mexico, 33% in yield, selling at half of book value. Wow, let's take a look at that. But this was a book that was delivered by mail, and you had to look through it. Now, of course, I mean, nobody does that. So forget social media, just look at Bloomberg. You know, everybody can screen on Bloomberg for high yields and low book value. So, but the important thing is the information is so much more accessible to everybody. But as G.K. Chesterton said, we might have more information. Do we have more knowledge? And we have more knowledge, but do we have more wisdom? And so the key is not finding the Telefones de Mexico with a 33% yield, but finding it and saying, I think the macro environment is good for this company. And that's more than just social media and Bloomberg. That's having a knowledge and an understanding and an analysis of sectors and markets.
Well, let's talk about the senior gold producers, and I guess you include the mid-tiers. What sort of screening or what are you looking for that I guess doesn't work? You know, how do you eliminate companies from, like, there's, again, even the senior producers, there's quite a lot of choice. So how are you going through and picking what fits?
Yeah. Well, first of all, in all my investing, people and balance sheets are the two most important things for me. Now, obviously, with the larger the company, you might argue the less important people are compared with the smaller company. But I would say they're still very important. It can be very, very important. I mean, just think of Steve Jobs and Apple. Would Apple be what it is today if it were not for Steve Jobs, a single individual? No, it would not. And you can say the same about many, many companies, major companies in the world, even long established companies. the CEO can make a very, very significant difference. So that's the most important thing for me, the people. And then also the balance sheets. I have an aversion to debt. Obviously, in a capital-intensive industry like mining, it's not forbidden to take on debt, but it's a matter of how much is the debt and can you service the debt comfortably out of cash flow. I do look very much at debt, and I look at the ratios, like the quick ratio or the asset test ratio, as they call it, just to give an idea of how comfortable the debt is. I look at debt maturities, for example. Do you have a company where they might have you might have two companies with similar debt to equity or debt to asset ratios, but one of them, all of their debt is coming due in the next 2 years, and one of them, their maturities go out for 10 and 15 years. A company like Freeport, for example. So if you're looking at a company that has to roll over their debt this year and next year, then you have to look at, well, what interest rate are they paying right now? And if they borrowed that money 5 years ago and they're having to roll it over this year and next year, their interest service is going to go up considerably. So anyway, those are definitely two things I look at. Beyond that, it's really what the quality of their mines is, and quality includes the growth of their mines, their brownfields exploration potential around their existing mines, and that's part of looking at their pipeline. Pipeline is very, very important. So, those are some of the factors. So if you look at a company like Agnico, for example, the third largest gold mining company in the world, is a company with a strong balance sheet. It's not as strong as Barrick's, but it's still a strong balance sheet. Very strong management, and importantly, a deep bench of management. Mines primarily in Canada, primarily in Toronto and in Nunavut, in Australia, in Finland, in Mexico, all of which, and those are in declining order, by the way. So Mexico, which is the highest risk, is where they have lowest exposure. So a very, very strong political risk profile. Again, compare that with Barrick or with Newmont. And a very, very strong growth profile. When they bought Kirkland, they bought not only a producing mine, but they bought a lot of exploration land, developmental land around their Detour project. So they have a mill with excess capacity, and they're going to be able to mine some of these other areas and bring it to the Detour mill. So they're going to be able to bring these mines on at low capex, because you don't have to build a mine, and at low operating costs because the mill's already there. So anyway, those are some of the things I look at.
Excellent. Adrian, what is the best way for viewers to follow your work and yourself?
Well, the website, if you go to adrianday.com, it'll take you either to the newsletter or to the money management. And we've got lots of interviews with other people. Sorry. We've got lots of interviews and articles posted on the website.
Excellent. Adrian, it's been an absolute pleasure chatting today, and hopefully we do it again soon.
Yeah, no, thank you very much. I appreciate it.